Mr. Anandan, for joining in. You had earlier promised that, asset quality will improve and the first quarter was just a blip. But as far as the loan growth is concerned, that is something that I'd like to ask you. This quarter, you've done around 32%, and you had guided for around 25 to 30% growth this year itself. What's driving this loan growth, and how much do you think you'll end this year by? Will it be above that band of 25 to 30%?
Yeah, thank you. Given our customer profile, which is largely in Tier 2, Tier 3, Tier 4 cities and self-employed and housing for their own occupation, and our given the size of the loans, the demand for housing and housing loans are fairly high, and the pie is large, the penetration is low. And we are seeing the growth coming back fully after the COVID. So we did recorded, as you mentioned, rightly, good growth of little over 30% on our loan book in the first 6 months. And going forward also, we expected to, we expect to maintain the same growth rate of about 25 to 30% CAGR, into the future.
Okay. Mr. Anandan, like Mangla mentioned, there's been an improvement which has taken place in terms of the asset quality. But what can you guide us for when it comes to collections and recoveries, probably in the second half? Do you expect the kind of momentum that you've seen in asset quality to continue into the second half? The reason I ask is that we're working in an environment where there are layoffs taking place by tech companies globally. Inflation is on a downtrend, but obviously central banks are tightening. So given the context of what might be taking place, what do you foresee in the second half?
Our asset quality is good and our collections have substantially improved. And the last 3-4 months, our collections have been little over 100%. And given the size of the loan, size of the MI, the impact of inflation, not really affecting in relative terms as much as the other segments of the home loans, possibly. But, so we are really seeing a good repayment track from all our customers, resulting in our stage 1 is almost about 94.5%, and our stage 2 is around 4.5%. And our NPA is around 1%. And this we expect to continue into the next 2 quarters also. In addition to that, we have also taken a decision to follow a prudent provisioning policy, and we have substantially increased our provision in the current year. Right now, we carry about 1% of our entire loan book, we carry as a provision. And for NPA, we're really providing about 25%. Okay. So that way, both in terms of the recovery, collections, and the provisioning is good enough for us to sustain into the future as well.
Okay, so that is the idea on your asset quality, and generally you've given a growth target on loans as well. Let's talk about your net interest margins, because we are in a rising interest rate scenario. This time there was a decline of 5 basis points. It's a minuscule amount, but it has declined nevertheless because of higher borrowing, which increased around 27% on a quarter-on-quarter basis. So what is the idea on NIMs? Will they continue to stay stable, or will you see some decline in coming quarters?
No, actually, for FY23, we don't see any decline in our NIM, primarily because of our very strong balance sheet and very strong liquidity position. Our balance sheet size as on September 22 is about 7,000 crores. Of that, closer to about 3,200 crores are net worth, and balance 3,800 is the borrowed funds. Within that, 60% of the borrowed funds are fixed interest rate for another 5 years. So, it's a long-term loan with a fixed interest. So the inflation, increase in interest rates will not impact us, at least on the immediate short term, on that 60%. And the balance 40% of 3,800, about 1,300 crores. Also, it's linked to the 1-year MCLR. And to that extent, we have leeway. And our credit rating also has been upgraded in December 21 And that also we are leveraging to, not to really go for any increase in our borrowed cost. On top of all these things, we also got a sanction of about 500 crores from NHB, which has not been drawn. And, the NHB funding comes at a, relatively lower cost than the bank and other sources. That also we have kept it undrawn. So given that, we expect at least for FY23, we don't expect any increase in our funding cost, and we don't expect really any reduction in our NIM. Broadly, NIM will be same as it is today. And as you know, we enjoy one of the best financial metrics, whether it is NIM, ROA, ROE, when compared with the comparable companies.
We take that point, Mr. Anandan. Your AUM is growing extremely fast. Your asset quality is under control, and at the same time, you don't foresee any big risk to NIMs, etc. So you are doing well on all those parameters. However, one niggling worry is that as your book grows, your operating costs also are increasing. In fact, this time around itself, your employee costs were higher by 49% quarter on quarter. At what point does operating leverage kick in? I mean, what is your target cost to income ratio going forward?
Basically, as you must have noticed, our OPEX is one of the lowest in the affordable housing finance industry compared to other competitors. And the increase, you are right, there is some increase in our manpower cost, in this period. Primarily because if you look at while the loan book has grown about a little over 30%, our disbursements are really grown almost 60%. And part of our cost, a variable component of the cost linked to the disbursements also is one reason. And second thing is that, when you really compare, in fact, on a year-on-year basis, FY22, April 21 is fully closed because of COVID. Whereas FY23, it's a 6 months data. FY22 is a 5 month data. That also is there. And our increment period also comes from effective, first of April, first of May kind of thing. So, but barring this kind of specific issues, inherently our productivity is one of the best, and our OPEX is one of the best, and then continue to be so into the future as well.
Okay, sir, just before we wrap up, I just wanted a quick word from you with regards to which segment are you probably betting on in terms of growth, because you have your regular home loan segment, but you have this quasi home loan segment also, which is basically, houses which are directly for construction and the loans given out to the individual for that. If you could just give us which segment are you probably betting on in terms of incremental growth, and between the two, any slowdown?
Basically, at a broader level, there are two segments. One is our home loans, which in a way include the quasi-home loans also. And the other segment is our loans to the small businesses, SMA loans. Now, SMA loans is a much lower percentage, of close to about 6,000 crore loan book SMA portfolio. It's about 700-800 crores only. There, given the impact of COVID and given the repayment culture, the growth rate will be slightly lower. But we will continue to have a very strong growth on the home loans and quasi-home loans. Quasi-home loans also mentioned is almost home loans, but it is not meeting the regulatory requirements in some form.
Okay.
But otherwise, we are expecting a very, very good growth to continue into the home loan segment.
All right, so we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Aptus Value Housing, talking about the fact that maybe the Ross NPAs will be maintained going into